Good afternoon, everybody, and welcome to Live Market Analysis Macro Edition. If you don't know what macro is, it is everything around the world that could possibly impact your portfolio. So we're going to look at bonds today. We're going to look at foreign exchange. We're going to look at commodities, crypto, global economies, what's going on and how it boils down to moving your portfolio up or down. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia. It's a pleasure to join you as we have a very simple format today, and it is just find the Q&A window somewhere there on your Zoom platform, if that's how you're tuning in, or if you're watching me on any of the streaming services, that is Facebook, LinkedIn, Twitter, or YouTube. You can also ask me questions as well, and I'll give you my best technical and fundamental analysis reader. Let us head over to the charts. That is not where I'm going to start today. Magellan Financial Group, pure coincidence. Happened to be something I was looking at before the presentation. And we're going to start here with the NASDAQ. First thing we'll notice is that the RSI has disappeared. That's because we're basing the NASDAQ against the NASDAQ. So, of course, there is no relative performance when you're comparing something to itself. Just zooming in a little bit there, and we can see, let me just fix that, in fact, and we'll do that much better. All right, we'll start here. We'll do a bit of a loop around the grounds, and then as I'm doing that, put in your requests. Okay, so we have, or had, the most wonderful of bullish trends. The seeds of that trend sown through February, March and April, and finally in May, that great release. And up we went with high peaks and high troughs, predominantly white candles, okay, and lower shadows as well, very important. We took out potential areas of supply quite easily, actually. Really only 13,181 offered any showing of supply at all through this candle here. But up we went again, and 13,711 appears to be where we are finding some supply. Having said that, we got through that level on the first go. But the supplies arrived. How do you know the supplies arrived? Well, hello, black candles. That's your first signal there that supply is in the market. Supply starting to overwhelm demand, because up to that point, demand had no problems at all dealing with the limited supply in the market. Okay, that's the day that starts to change things. Also note a significant pulse in volume there. So potentially what happens is all of that enthusiasm, all of that excitement drawing in the Johnny-come-latelys, the weaker hands potentially that aren't necessarily in for a long time, they're just in for a good time, okay? And if you put those weaker hands under pressure, there's a good chance that they will get scared and spill out of the market. The fund managers know this, of course. So the volume coming in from all of that uber excitement, and if there's lots of demand, okay, and there's lots of supply to meet that demand, we're going to get lots of volume. And volume when a security is going up or down is not necessarily meaningful in itself, but volume, when we pair it together with price action, does become meaningful. So for me, we've got a bunch of Johnny-come-latelys, a bunch of good time traders coming into the market at what is now a top, stamped out by the big money who was happy to give them their demand. Next candle, not too bad actually, closed just off the lows there, nothing to panic about, and I certainly wouldn't advocate on just seeing that one black candle, because it wasn't as big as the prior white candle, didn't take out these little shadows here. So that this candle here, and the one I'm talking about, if you're not sure, is that one there, is not enough necessarily to just dump all your long positions. And certainly the next candle was constructive for gains, okay? In this idea that the market has become prone, and this is it, the market psychology has changed from selling into rallies to buying pullbacks, okay? And buying pullbacks is a bull market mentality, okay? As we go back further than that, you can see how bull markets look and how they work, okay? I reckon we're probably somewhere around here, okay? Maybe the last couple of black candles represent this candle and this candle here. Maybe we're here, I don't know. Maybe we've got something a little bit more sinister coming up. But I would say we're probably somewhere around here, order of magnitude, okay? You're going to get those showings of supply, and they're not a bad thing. What really matters is how the market responds, okay? And the Leica zone is going to become extremely important for us over the next few weeks and hopefully months and hopefully years. And then the dark, well, let's say weeks and months. And it's the dark green zone that will then become most important to us over the course of months and years. But we are probably getting a little bit distracted here. The important thing is, look, we do have a dark green zone. It's fledgling, but it's there. And there's our light green zone. And we know that the light green zone, for me, represents a value zone where we can often see mean reversion back to. Okay. So there is a possibility that we see, with a few more black candles, potentially a move into here. And then we'll see how we go from there. Okay. How will we know that demand has come back in to signal that up we go again in the good old bull market? Well, we're going to see the white candles pop back in. We're going to see the lower shadows telling us that the demand side, the longer term investors who probably orchestrated this little pullback here, are buying back any stock that they sold to the Johnny come latelys. It'll be the Johnny come latelys spilling out. Now you can guarantee all of those day traders and short term traders spilling out, regretting their decision to buy at the top again. Last night's candle, not great because it took out that little lower shadow. And if we just label them, label these candles here. So let me just get rid of a few of these that are in the way. And if we say that this is candle 1, and this is candle 2, and this is candle 3, and I'll fix them up in a second. Then push that one up there, push that one there, push that one there. Maybe works better. Okay, candle 1, 2, 3. So candle 2 is all about buying the dip. That's the mentality of the bull market. Is it a 2-day dip? We've seen plenty of 2-day dips. Candle 3 tells you it's not a 2-day dip. It's a bit more than a 2-day dip. There's still some supply in the market. So we're going to have to find the light green zone probably. That's how I read candle 1, candle 2, candle 3. Candle 1 for me is not sell everything. Candle 2 is everything's normal. Candle 3 is okay. We've got a bit more of a pullback here than we've had probably up to this point. But I think it is just a pullback because of the light green and the dark green zones. And until I see something more sinister, that is the way I would continue to position myself. Now, what is the definition of more sinister? We've talked about what is not sinister. We've talked about white candles, lower shadows coming in that light green zone. The more sinister stuff would be actually where we think we're going to get demand. And we think we're going to get demand probably in and around here because past points of supply tend to act as future points of demand. So if we look at that area there, in fact, let me just change the color so we can see it. There we go, POS, potentially a pod. And note how the pod also lines up with where the light green zone will be catching up to, because this is going to continue to move higher. Black candles in there would tell me, wait a second, the demand I thought was going to be there isn't there, and we've got potentially something more sinister. Okay, so watch out for black candles in that zone. The other thing that would turn this around for me completely would be if I started to see lower points of supply. So here's our POS up here with the recent peak at 13,865. And if I was to see another POS put in over the next few days, even up to the next couple of weeks at a lower level, that would concern me. And then this area here would take on even greater importance. Until then, it's all just prognosticating, isn't it? I'm not a prognosticator. I'm a reactor or a reactionist. So let us not go too far into the future there. So look, alert, not alarmed, I think, on what's happening. Let's have a look at some of the other US indices. S&P 500, very similar. Ditto on the NASDAQ. Probably a milder pullback last night's candle, isn't it? Maybe less to worry about than there. Let's have a look at the Russell 2000, the small capitalization stocks. In fact, last night's candle, very, very mild. Yes, we did see some supply coming in around 1907. So I'm encouraged. I'm encouraged by the fact that the less technology-focused indices, certainly the Russell, maybe less the S&P 500. S&P 500 is still very much technology-focused because of the influence of those big tech stocks. But this one here, very little influence there. And I think that's actually held up pretty well. And I can see quite a bit of demand probably coming in around that 1820 to 1840 area where the moving averages are sitting. And if we do see that, I think it's actually going to be really important. So watch out. I mean, this is the chart you want to watch, I think. So watch out for a rally off here. And then that, I think, will reinforce the NASDAQ's move. And I think a move like that would really put us into this next bull market, or give everybody confidence that we're in it. So that's not too bad. A couple of other ones. Let's have a look at just quickly the mid caps. Not too bad there. And the small caps, again, reflecting the Russell. Actually, a little white candle on the small caps. So that's pretty good. Looking for the red flags here, banking sector, not great, but it's been relatively quiet. That's not much fun there, the regional banks. And I have said many times that if there is going to be a calamity, it may well come from this regional banking index. And no doubt you've been Googling things like, commercial property in the US and potential defaults there and potential 2007 style calamities that could befall the market. I'm not saying that can't happen. I'm just saying this is where you'll see it start to manifest itself. Okay, so I'm aware of all these things. I'm not a one-eyed bull at all. That's just not how these things work. The other thing there is the SKEW index. I know you can't see that, so let me do the line. That's actually come down significantly. So we can see as we're heading up there. I think markets were quite nervous. I think that situation is settling down, so that's encouraging. And the volatility index continues to make new lows. So I don't think there are any major red flags coming from those. I want to just head down here and check out some of the European indices, because we do know that the DAX did make a record high last week and has pulled back in line with the everything else trade. And I'll kind of get to the heart of why everything else is pulling back in a second, but I think that's still largely intact. I don't think I want to panic about that just yet. And let's get to the heart of why stuff hasn't gone so well. It's mainly to do with this chart here, which is the China A50 Index. So we did get the stimulus. Did we get the stimulus? We got some stimulus. So the People's Bank of China reduced their reverse repo rate, the overnight rate for Chinese banks by 0.1 of a basis point, minuscule cut there from 2.9 to 2.8 or 2.8 to 2.7. I can't remember, but it's that's the order of magnitude. And then on Tuesday, we saw them cut some lending rates to mortgage holders as well. So the 1 and 5 year rates, if I'm not mistaken. I haven't got the right rate. Please forgive me for that. I'm trying to remember the exact rates, but order of magnitude, that's what it was, and it's about order of magnitude 0.1%. So the message there is whatever the rates are, and apologies if I got it wrong, the cuts were, and this is where I'm right, 0.1%, and that's very, very small in the whole scheme of what the market was hoping for. The market was expecting far more action from Beijing to arrest this precipitous slide in the Chinese property market. And if you don't know what the precipitous slide in the Chinese property market looks like, let me show you what it looks like. I'm going to switch over to here, and hopefully that will appear on your screen anytime soon would be nice. Thank you. Let's get this going while I'm here, but now it'll appear. There you go. And we are going to head over here and look at the property indices, because I don't get those on Amy Broker. So 000948 is what you're looking for there, the CSI China Mainland Real Estate Index, for those of you who want to follow along at home. And this is your stimulus bounce through here, right through there. There's your stimulus bounce, and we're going to look at how it impacted commodities in a second. But you can see, and again, don't get sold the dummy. Commodities tend to pop. The high beta play on this, but this was the most muted response, and then straight back down again, and that is concerning for me. And then the Hang Seng Mainland Properties Index also coming down, maybe not as bad as the other one, but still pretty awful. And the China 50 shares we just looked at recently. So this doesn't. What does it mean? What does it mean for some of these big commodities? Let's head back here and kick off with the biggest bulk commodity there is, certainly for Australia, and that's iron ore. Let's zoom out a little bit, and maybe even head over to here where I have my scratchings on iron ore. Modest pullback, to be fair. I think that's a very strong performance compared to the rolling over of some of those China property indices. But watch those indices, because it's not necessarily conducive for this to continue to move higher. But we are seeing a bit of a modest pullback there. Let us head next to, well, I guess if you're going to use iron ore to make steel, which you need in your big property towers, apartment towers they're trying to put up over there, you're going to need some nickel as well. and that has turned lower. So we did see that pop, 20,000, 23,000. It was all over the news. A few of our local nickel miners got a bit of a rally there, and let's face it, straight back down again. And then let's go to copper, last but not least, and we can see it has curled over, much as I predicted it would, at that dark pink zone, just starting to curl over here. All is not lost. Look, if we get a pullback to say 8,400 and a pick up again, it will be making a very, very attractive inverted head and shoulders pattern, and possibly we can move higher into, say, that 9,000 to 9,200 area. If it just rolls over, which I think there is a very good chance it will, we'll probably come back down and test into 7,900 once more. But I think a cautious approach is required, not only what we're seeing on the Chinese property side, but some of these commodities rolling over again. And what the keywords, so how will you know when we've got the stimulus we need? Look for special issuances of government bonds to fund infrastructure projects. That will certainly help out. Reducing potentially the requirements or the hurdle rates for borrowers to get loans, that could also help out. But ultimately, we need to see further support from Beijing at the local government level, where, let's face it, we just have so many of those zombie municipalities there that are just absolutely loaded, burdened with debt, and there's so little they could do even if they wanted to. So yeah, we need to sort that out, and then we need to create demand at the consumer side, and it is not going to be easy. So when you hear, this China stimulus, here goes the rally, and go out and buy your resource companies, I think you're taking a very simplistic view of what is a complicated situation in reinvigorating that Chinese economy. And the chart that I think you just need to focus on was that one before on the Chinese property sector, which continues to languish. There it is there. That's a pretty good whip around the grounds. You've all been very, very quiet today, possibly because I haven't actually opened the window where your questions are coming in. Haraju wants to do soybeans. We'll do that. What else have we got coming up here? If we go from the rest of them, from Subash, let me just address this. RNU, Subash, I don't do that on Thursday, I do that on Tuesday. Tune in on Tuesday, register for that one. That's where I talk about Aussie shares. Today it's all about macro. From Kirsty, Carl, if all the commodities are heading down, does that mean we should be looking to gold-related stocks? Wonderful question. I'm going to get to soybeans in a second, Raji, but let's head to gold, and we'll just stay on this idea of metals at the moment. And to get the gold chart, we need to head over to here. Okay, so the question is, if all commodities are heading down, should we go to gold? Well, I think if all commodities are going down, it doesn't help gold. I mean, gold loves it when you've got inflation. It loves it when you've got very, very low interest rates. When there's uncertainty in the world. Yes, there's uncertainty. I think that's a tick. Very low interest rates. Does the Chinese situation lower interest rates globally, particularly in the USA? It does support lower rates. Yeah, apart from that, I'm not sure, because the global growth output story that's the big question, and that's definitely not going to hot up anytime soon and create inflation, so that's not helpful. Yeah, net, I don't think we can look at other commodity prices or China and say that there's a reason to buy gold, I think, to answer your question specifically. But let us look at the chart of gold and determine whether we should buy gold. And I think the answer is still no. The short-term trend is very much set to the downside. I know we got a little bit excited here, didn't we, at this candle and the potential of a rally there, but there just wasn't enough in it. And that was always the problem with the chart, wasn't it? That we turned quite convincingly through here, and really, as much as gold has continued to fight, you can see the regular white candles and lower shadows coming in. I think it is more and more losing the battle. However, we are at the dark green zone. We know that at the dark green zone, gold has rallied nicely in the past, But I would say you're not jumping in now simply on the basis that we're at the dark green zone. I think you need to see this, at the very least, those two coming in, pop, maybe taking us above 1985. And I think then you can start to look at going back into gold and adding some risk back in. And maybe that's probably overkill. But at least the first two in or off this zone here. So until then, I think we're still pretty neutral on gold. You're probably in the very short term, more of a short bias. But given the long-term trend there, I think neutral is the best place to be. How does that translate back to your gold-related stocks, Kirsty? Well, we'll look at gold stocks on Tuesday, but I can't see any major catalyst on screen to tell me that I want to rush out buy gold stocks at this point in time. Have a quick look at silver while we're here. It did have quite a nice little pop through here, didn't it? It actually printed one candle, which I would have said was sending us back to the races, but it just flamed out so quickly. And worse still, you can see here that our points of supply are now falling. That's one there and then one there. And we've cracked through that middle point of demand that always sits between 2 points of supply. And with the pretty bearish black candles, not looking very good. And even worse, I think we've actually closed beneath that point of demand there, that major point of demand. So I would say the outlook for silver looks quite bearish to me. And until I can see, again, a reversal, a couple of nice white candles coming in to help us out, I would say the bias to silver is set to the downside. Okay, so the fact that we're breaking through this long-term uptrend zone now, I do think is a problem. I'm happy to stand corrected by the market, but it's not an area I'd be holding long positions on at this point in time. At best, neutral. At worst, starting to consider shorts, because if we do decisively close beneath this this level here, which the low there is 2266, then 1988 is the next logical area to target. Why is Bitcoin going up, says Josephine. Let's do that now. I think it's similar to gold in terms of some of the fundamental drivers there. So Bitcoin also loves very low interest rates. And Bitcoin, whose chart is over here, has had a huge run. And look, you only ever get excuses, Josephine. You never get reasons as to why stuff happens in crypto, because nobody actually knows. But the excuse this time is that BlackRock and a couple of other big ETF providers have lodged applications for spot Bitcoin ETFs. And BlackRock is the key one because they're just such a heavyweight in the industry, and they've got a very good track record of getting these types of securities approved. So that has given Bitcoin a bit of a shot in the arm. I suspect, as much as that might be the reason for its rally, probably a bit of short covering is at play here, because I think the hedge funds were very much shorting this one. As you can see there, that recent downtrend and then even breaking through the dark green zone. So short covering, a bit of spec buying has pushed it up into what is a major point of supply up here at 31,053. And if you weren't on it, I don't think you need to be on it, simply because that should be a point of supply. But let's see how it responds here. Bunch of white candles, bunch of lower shadows around 3105. It will, I think, go higher. Bunch of upper shadows, bunch of black candles there. Then we will see probably some sort of pullback, maybe back into an area maybe around here, or even here, probably more likely 28 sort of 5-ish. So white candles, lower shadows here, very good. Black candles, upper shadows here, probably going to see more of a pullback. Other than that, we'll head, while we're just looking at some crypto, into Ethereum, which has experienced a similar rally. I wouldn't say the Ethereum chart is as good as Bitcoin. I think the downtrend has been far more severe, and you can see it did crack beneath that long-term trend, in fact, changing it back to amber. But a welcome rally there for the Ethereum bulls. And again, probably this area around 1900, little point of supply, gives it a point to pause at. Would I be jumping into this? Look, I love the fact that we've got a bunch of white candles, but I think just see how the supply side responds now, because we know the supply side in crypto is pretty strong and pretty powerful. And if we only get a shallow response from the supply side, then it suggests to me the supply side response is very mild. The demand side is still very strong, and we may get another move up. I don't think there's any point looking at any other cryptos here. If you've got one, let me know, but there's just the decimation everywhere else outside of the big two. And really, Bitcoin is really the only show in town at the moment. Okay, did have a question from Haraju about soybeans earlier on. Let us head over to that one there, the little green soybean in the logo there. Nice move up, and we've seen a pretty sharp move higher in most of these grains. It started with corn here. You can see a nice move on corn. If I go to the weekly chart, actually, that's a big move. That's potentially a big breakout coming there on corn. So there was some news related. I'm not even going to pretend that I know what the news is, but there was some news, trust me, because I read it on Twitter today in a post. Something happened with the crop, and therefore up she goes. Okay, not that again, honestly, don't be listening to this on the replay and thinking, oh, this guy doesn't know stuff. I don't care what happened. You know, read my lips. I don't care. I'm a technical analyst. It does make people feel a little bit more comfortable sometimes when they hear what is driving it. But hey, I'm just telling you, there was some news. Go read about it. I think that's a very interesting chart. But the question was about soybeans. I think possibly this has moved in response. Great white candles. The only thing that would hold me back, Raju, and I think you know what it is already, is the potential point of supply there. And let me figure out where the rectangle is. So just this in here. And it's a little bit like Bitcoin. It's a little bit like Ethereum. And there's no reason for those securities to be moving in the same fashion, is there? There really isn't. But they are. But we have the same sort of technical situation here where let's see how we respond. It looks very good. And even last night's candles telling you that we're really not that fussed about this potential point of supply here. So that is very, very, very bullish indeed. And let me just move that. So that's what we're watching. And then the problem is, even if you get in here, because that last run is so huge, try and grab this thing. You should be able to just grab it. No. Oh, gosh. Why is it so difficult? This is why, ladies and gentlemen, I do my drawing and AMI broker for no other reason. You can do whichever one you prefer, but this is the one I like to do. There's your next supply zone up there, Haraju. So getting into longs here, I'm not saying it's a bad idea. I think the candles are incredible. But how do you work out your reward to risk? And there's got to be a point in your trading where you go, this is the best setup I've ever seen. It's probably going to go up. And then you have to balance that against, well, if it doesn't go up, where's my stop loss? Maybe somewhere down here beneath this big demand candle. And if that's the case, if I'm getting in here and I've got this much downside, then I have potentially limited upside. And it's only potentially, because who's to say it's going to stop at that major point of supply? Who's to say? It may not. It may go straight through it. But do I want to take that risk, or do I try and find a setup that is giving me just as strong a signal on the underlying technicals, but also has better reward to risk as well? Cocoa is one we looked at very recently. That's been going very well. We still don't have it at ThinkMarkets, but look, if you manage to get it somewhere else, it looks amazing. I would say continue to hold it. I think we tipped it somewhere around here, so you're doing quite well on that one. Coffee maybe hasn't had as good a move, but I still think is intact. The lower shadow there, I think, is constructive, but let's face it, there is a shot across the bow in terms of the supply side there. Let's have a look at high-grade copper, because we discussed London copper earlier on. You can see there is the rally. Perhaps this has got a better showing of demand in that value, short side value zone. So maybe that's giving you some hope there, copper bulls, that we can make that inverted head shoulders pattern we talked about on the LME chart. So the LME stands for London Metals Exchange. This is the COMEX one, trades in the USA. Colin's asking if we can look at gold. Colin, I have done that. So if you came in late, catch the recording. The drought. You're absolutely correct, Kirsty. You probably saw the same post I did. There is a drought. But I would think that the drought didn't just, well, there's a drought. I would have thought we'd know there was a drought and that wouldn't cause such a huge rally. But that was the news article that I did see flick past my Twitter feed. Okay, Neil, is there a problem with the audio? It's just referring to your comment there. Now, I don't think we can do a session like this without talking about the old favourites of lithium. You know where I'm going. So let us head here. And I've noticed we have had just the tiniest of pullback. And through this phase here, it has been one-way traffic. So every day's print has at worst been flat or better. And we've had 2 prints in a row of the most gradual pullback here on lithium carbonate in Shanghai. And doesn't surprise me. I said we were going to probably find a level. And the next move is, I think, the decisive one for lithium. I think if we break back up again, it's on again, right? We'll probably go up and make new highs for lithium minerals. But if we roll over, and that is my hunch, ladies and gentlemen, if you roll over, hey, I'm not a lithium bull or lithium bear. I've just seen charts do stuff for many, many years. If we roll over, then we're going to have some problems. And I'm happy to stand corrected on that one. At the moment, it's not rolling over. We've had 2 days down of the most minuscule amounts. Okay, so, but just keep an eye on it. And this is why we tune in every Thursday. I don't think you need to look at the charts every day of the week. I think that would be unnecessary. But having a look once a week at these big picture moves, you know, this is supposed to be the mega trend of this decade. Lithium hydroxide prices have come down slightly more significantly than the lithium carbonate prices. This is based upon the, actually this is based out of Shanghai as well. This is a Shanghai contract too. And just a bit of a pullback there. I know this one's priced in US dollars, but it is a contract that's based in Shanghai. So a small pullback there. Hopefully that is not the rollover I was talking about. Okay, just checking Aussie dollar. We've got some questions about Forex coming through. So let's do some of those Forex trades now. Going to head back to here. And we will go up. Forex is already here. Before we do the Forex, I think we'd be remiss not to check the interest rate situation, because Forex moves on interest rates. And I know this, if you go into YouTube right now or TikTok and you Google how to trade Forex, you're going to get hundreds and thousands of people about half my age, okay, telling you about this great Forex trading system they've got. And they're probably sitting in an apartment many, many floors up overlooking somewhere, and maybe or driving in their Lamborghini. And they're going to tell you about this amazing Forex system they've got. That's not how I do Forex. Forex moves on interest rates, okay? Not based upon what some young punk tells you to do. Now, the higher the rate, the more demand there is for a particular currency. I should say the higher the rate of a currency jurisdiction versus another. And even then it gets more complicated, because you need to understand how those expectations are changing over time. But if we dumb it down to its simplest form, that chart on screen, if it's more bottom left, top right than the next one, you're probably going to find that currency appreciating against the next one. So Aussie US yields on screen, 2-year yields, just where I like to be. I think the market's very much focused on those 2-year yields at the moment. Other times when there's not a lot happening, 10-year yields tend to be some focus. I'm using the 2s at the moment. So US 2s continue to creep high, but you can see a little bit of flattening out there. The key one I still think is this one here, which is still going gangbusters. So we have to expect that the sterling is going to be strong against the other crosses, okay? Particularly the yen. The yen is still a funding currency. That is still trending lower compared to everything else trending higher. And the German bunds there as a proxy for the European. I could use other, like the Euribor rates and things like that, but I just like to keep it all consistent. And that is still very strong. So we would expect some strength in, say, Euro crosses as well against, say, US and yen. And let's finish looking at the Aussie. That has been a monster move, but we had our Reserve Bank of Australia come out and give us quite a dovish view, actually, of where rates are going here. So this is the Reserve Bank of Australia futures implied yield curve, and we can see there that is from Monday. So just before those minutes came out, interest rates were expected to top out here in Australia at about 4.65%. So currently at 4.1%. So that's implying greater than 2 further 25 basis point hikes by around about November. And then you're not getting anything which resembles a cut on screen. Now, rewind a couple of months after the April pause, let's call it skip, not pause, because they only skipped, they didn't pause. We were expecting rate cuts as early as sort of January this year, okay, and the rates to top out only around about 3.6 or 3.7%. So you can see how dramatically that has changed after those two rate hikes from the RBA, and also illustrates just how poor their messaging was. Markets shouldn't do that. Markets are good at assimilating all the same information the central bankers are assimilating. Think about what that means. The market, all these economists, all getting paid way more than I do, assimilating all this information, the same data the RBA is looking at, and making their expectations, telling their dealing desk what to do. And yet we saw such a huge shift in how the market had to think. That tells me straight up that the messaging from your central bank was bloody awful. Love them, hate them, whatever. Their messaging was terrible, and the market has shown that. But fast forward to after the RBA minutes, also demonstrating just how bad their messaging is. Now they've flipped dovish on us, and we can see that in November we're down to 4.5%. We're still going to get at least one more rate hike, but that is moderating, and you can see where we go from there. So that's interesting. Now, still means, look, I mean, that's all talk, of course. Well, pictures and talk, but at the end of the day, it's just telling us what it could mean for the Aussie dollar going forward. And I think the angle of attack here is still very good. So probably strength in some of the Aussie crosses, and New Zealand actually looking like hotting up as well. So look, long story short, anything against the yen should be good, but maybe favouring, dare I say it, even Aussie, sterling, euro, and it'll be all about how they compare against each other. I didn't look at the Swiss actually, but Swiss yen also looks very good. So this is where I think you want to be positioning yourself in foreign exchange. Now, I know that's very boring, and most of you who love to look at those TikTok influencers driving Lamborghinis just fell asleep because I wasn't talking about a 5-minute chart. But if you do want to do 5-minute charts, understand what the big trend is, understand what the big drivers of Forex are, and that can help you at least take trades in the right direction. Okay, and hopefully you end up with your Lamborghini after that. Now, Swiss yen, I think looks amazing, but then we're going to go to anything against the yen looks amazing. The one I gave you 3 weeks ago now, which was, I said, was my pick of the bunch, is the sterling yen, and that has been the pick of the bunch. That has knocked everybody's socks off. I can't remember what my target was, but I think it's pretty close to my target. The one we looked at last week was the dollar yen. It's done okay. I mean, I did say at the time, it's not going to be as good as the other one, but probably have a bit of a rally. But anything against the yen is good. And then, look, I mean, do you go for, say, some of the sterling crosses? You're trading on the same theme. And this is the other thing you have to understand about foreign exchange. It's not like the stock market where you have thousands of different companies you can choose from to really get diversification, because company A's business will thrive when company B's business is in the toilet. If you're long the sterling versus the euro, or the euro or the Aussie, or versus the yen or the Kiwi, you're long the sterling. Okay, so just be careful with that. Understand how to manage your risks in that regard. Simon did ask specifically about the Aussie versus the US dollar, and I haven't answered the question. But look, adding some colour around that, the Reserve Bank has ruined things. I do think, however, that there's a more bullish outlook or hawkish outlook for rates in Australia than there is in the US. And therefore, this could probably be stronger for longer than you think. Okay, I know that is just hedging my bets, but how can I give you, Simon, a decisive call on the fundamentals? Forget the fundamentals when the chart is very much amber and, yes, light green on the short-term trend, but it's still very indecisive. I do like this huge move up here, and this is very interesting to me, this sort of a move here, and then it comes down to how the supply side responds. And we have seen some supply in the market, a little bit of demand coming in here. We should expect that the long-term trend zone, which has just been so awesome at telling you where those rallies are going to terminate, it could now well act as demand if we start to see those white candles coming in. in line with the bigger picture I talked about. Yes, I think this can go higher. We could well target into 71 for, if we were to break beneath, say, 67, okay, something's wrong with that thesis and we're probably heading back down again. So there's a push and pull here. We've got the rate situation, which I think is constructive for strengthening the Aussie dollar, but then we've got the China situation, which is what we talked about at the start, which I think is not good because obviously going to impact commodities. Okay, I have pretty much done everything. I mean, if this is a macro webinar, we have done bonds, we have done commodities, we have done foreign exchange, we have done crypto, we've done global stock indices. I'm not sure what is left to talk about. So unless you have something else, we might well adjourn here at this point. But, hopefully for you, it was a fascinating look through the markets. It always is fun for me to do. Let us head then, if there are no further questions. Jill, of course, talking about uranium. We nearly got to the next slide, Jill. We must look at uranium. It's not we should look at uranium, we must look at uranium. And it has had a little bit of a pullback here, Jill, but I don't think anything too sinister there. I still think the trend is strong. I think we're okay, and Jill, this is going to play out in months and years, this trend. So if you're a uranium bull, I know you want things to happen in hours, days, and weeks, but that is not how uranium works. Hey, I just kind of disproved my point there, because it can move. Let me go to the monthly and show you that it does move quite slowly, okay, quite gradually. Even here in this huge bull market, it was fairly gradual. Okay, this is marking many months and years here, Jill. Okay. And I'm actually really glad we looked at the weekly and then the daily charts. Actually, I think that's quite constructive. I mean, I think they both look really strong. And are we here? Is this where we are? Are we somewhere sort of around here? Just looking at what the how the short-term trends were building. In fact, maybe even more advanced, somewhere around here. And is this going to happen next? Let us not go there. Okay, I am, as I said in the preview today for the Zoomers, I'm going to be in Melbourne on the 22nd of July, as will Kel Butch and Jason. They're flying in from Sydney and McMaster's Beach, Kel. I'm pretty sure that's where he's from. Kel lives on the northern New South Wales beaches there, where he surfs and manages a pile of cash. As a first, I'm serious, that's what he does. He surfs during the day and then manages money in the evenings. And you definitely want to listen to him. He's written a bunch of books on investing, which some of you probably have on your bookshelf. Jason, of course, from Motion Trader, who has oodles of experience in the markets, and they're going to really give you some great information there on those days. And maybe I might hopefully just live up to some of the reputations of these two guys. The landing page will be ready tomorrow. I promise you. This is the last time I'll ask you to ping Nick Coulson at ThinkMarkets for a registration of interest, because tomorrow you'll be able to actually do that. If you want to know about Renascore Resources, Subhash, then tune in on Tuesdays. I do all the ASX shares for you. And on Friday, tomorrow, it's going to be super interesting. I mean, we have had a great run, and I expect when we look at the US stocks tomorrow, we're going to see that we're going to have to make some calls. We're going to have to decide how much we reduce our risk in that market based upon probably some of the signals. Hopefully, I've got a big white candle between now and tomorrow, so we don't have to do that. But hey, that is trading, ladies and gentlemen. Register at www.thinkmarkets.au/webinars to join me live in the Zoom session, or you can do nothing and continue to watch me on any of the streaming services, wherever you wish. If you're not a client of ThinkMarkets, you really should be, because we are the good guys in the Australian broking scene. We have everything you need to trade here. If you're trading in Australia, we have all of your good old-fashioned plain vanilla shares at a great flat rate, and you are Chess and Hin sponsored. And of course, we're here for macro today, so you can trade pretty much everything we've talked about today on our CFD platform without any commissions. I think that is a great opportunity there. We are an award-winning broker with an easy-to-use multi-asset platform. We just got nominated actually for another award for our platform, world-class trading apps, and of course dedicated account manager with 24/7 customer support. If you are watching on any of the streaming services, please hit the subscribe button, stay notified of any of my future video updates. And it's very important to hit the thumbs up button. So important as it helps us climb up those Google and YouTube algorithms, and so we can get our message to more people. Apart from that, it's been a pleasure chatting with you today. I've had lots of fun. Hopefully you did too. Learn a bit along the way. All the best for your trading and investing. Till we catch up again. Bye-bye for now. And before you run away, don't forget that everything we've discussed today is general in nature. It has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, you should consider it carefully or seek the help of a financial professional before implementing. You can learn more about ThinkMarkets and our amazing products by heading to our website and downloading our PDS.